my own experience at a local level here at Reading Show, we've actually, I guess it's a little bit I don't know, controversial, but times have never been better. You know, we're flying. The business is absolutely rocking. We're 60% up versus last year over the same period from COVID to now. We had record months, selling over $30 million in one single month. We've sold over $30 million worth of stock, sight unseen, virtual, from $600,000 right through to over $10 million, sight unseen. It's profound, absolutely profound. And it's a really exciting time, and we've had to go through quite a lot of change around how we engage with buyers, engage with the market, and also sort of support and nurture people through the process. And I think that's been one of the really great parts of what has been a very troubling time for lots of different people in the market. I think we're looking at a market that's a tale of two stories. I think there's some economic clouds, which we'll talk about, but there's some real winners in the market. Even in our local market, I think that the prestige pockets within our marketplace are going to absolutely fly. I think waterfront, beachfront, you're in one of those what we call sort of A-grade positions within the Noosa marketplace. You're in very good shape. I think there's a little bit of oversupply in our marketplace as well. So you'll see some things like, you know, units, duplexes, and some other pockets within the marketplace that have been sort of, I guess, over-delivered against. So there'll be some winners and losers in our local marketplace. But certainly, if you're holding stock in sort of prestige areas or in the highly desirable pockets within Noosa, you're in fantastic shape. So I don't want to take too much of the story tonight because I'm really keen to hear from both Tim and Anthony. For those that don't know who Tim Lawless is, and you should climb out from underneath the rock you've been living in. This is one of the really the great minds of property as the chief economist for RP Data. And we use RP Data for all of our property analytics, and we're really thrilled to have you here on board, mate. And we can't wait to learn a little bit about from you. Cheers, mate.
Thanks, Adrian. You get everybody. Great to be here. This is only my second physical presentation since March, so I really have to remind myself to put pants on before I came here. We've got a lot of sessions on Zoom, which if anybody is doing a lot of stuff on Zoom, it's business up top and body is down below. So it's been a bit of a silver lining in many ways, the COVID story for people who can work remotely. No doubt, Adrian, that's one of the reasons why we are seeing such strength around markets that offer up both a lifestyle opportunity, quite often affordable price tags, as well as the ability to work remotely or commute back into the major working centres as well. For those people who are on Zoom, g'day. And no doubt Adrian can send a copy of the deck around that I'm presenting today as well. And for everybody here, no doubt it can be sent around my email as well. So I wanted to talk for about 20 minutes. I want to run through some of the macro trends we're seeing around the country and then drill down more locally to what's happening around the Sunny Coast of Noosa. From both a values perspective, but also more of a context. Some markets haven't been as fortunate as Noosa, that's for sure. On one end of the spectrum, somewhere like Melbourne, where everyone's doing it quite tough. We can look at the economy, where we're moving through an unprecedented level of economic disruption. We've seen also demographic trends being basically stalled. We've seen people stop coming to Australia. Most of our population growth as a country is sourced from migration from overseas. And that's having quite a fundamental impact on particular segments of the marketplace, particularly rentals around inner city Melbourne, inner city Sydney as well. So let's start at a fairly macro level. I want to start looking at housing values nationally. Look what the trend has been like through COVID. So the graph I've got here, or the trend I'm looking at here, is across the combined capital. So it's a fairly broad measure here. Sydney and Melbourne have a fairly big weighting in this series. Interestingly enough, if you didn't know, Sydney and Melbourne comprise about 40% of Australian dwellings, right? So about 40% of our housing stock as a nation is in those two cities. But they account for about 55% of the value of Australian housing, just in two cities, right? So what happens in those markets tends to push the headlines around. But what we're seeing, even though those markets are still falling in value, is a stabilising trend. Who would have thought, say, back in March or April of this year, when everybody thought the sky was falling, that we'd only see housing values nationally fall by around 2% through this COVID period so far. And now it looks like they are stabilising. The last 4 weeks, we've only seen our capital city index fall by 0.1%. At one stage there, we're seeing values falling by only 1% month on month. But if you look across each of the different capitals, you can see the trends are very different. Right? You can see each of the smaller capitals, Brisbane, Perth, Adelaide, I could throw Hobart and Canberra and Darwin on that graph as well, and they've all started to move back into some level of positive growth on a month-on-month basis. Melbourne just starting to show some early signs of improving. A few weeks ago, you'd once again hold an open home or a private open home in Melbourne. Previously, you couldn't do that because of the stage 4 lockdowns. In about a week and a half, you can start having auctions on site once again. So we're starting to see listings coming back into the marketplace in Melbourne, but clearly that's been a pretty tough market. We're still seeing values falling by nearly 1% month on month. Sydney looks to be stabilising as well. When you think about some of the drivers that are helping the market stabilise, like it is, a big part is that jobs are starting to recover as well. And there's quite a stunning similarity between these two graphs. One's tracking housing values, the other is tracking the number of jobs being lost across the country. So you can see in markets like WA, the number of job loss is only down by about 1%. In Queensland and South Australia, that's only around 2%. New South Wales, a little bit less than that. Melbourne's still some way to go. Victoria's still some way to go to start recovering in jobs, and of course, that reflects in the property market as well. In Australia, it's pretty hard to get a mortgage if you don't have a job. Jingle Mail or Ninja loans here. Remember the Ninja loans, there was no income, no job, no assets, but we'll still give you a loan. That was a big part of what drove the GFC, was that irresponsible lending in America before, say, 2006. We're also seeing regional markets around the country showing a much more resilient trend. I've just got a few examples here. You can see the Sunny Coast and Gold Coast in the graph on the right compared to Brisbane. This is the rolling quarterly change in values across each of these markets. But outside of Sydney, the major regional centres there are Newcastle and Illawarra or Wollongong. You've got Geelong and Ballarat outside Melbourne. Values are still falling in those two areas. They're not anywhere near as much as what they are in Melbourne, and already showing some signs of turning around. And then you've got the Sunny Coast and Gold Coast, well and truly outperforming Brisbane, but all three of those regions now look to be stabilising, if not actually improving in values as well. So what about more locally? And as Adrian said, the local trends are much more diverse and very niche driven. Across the Sunny Coast, you would have seen that graph, property prices have been pretty flat, but up here at Noosa, we've seen much more strength in the marketplace. Maybe part of that reflects some of the media that we're seeing around regional markets being very strong, with demand flowing away from the metro areas into some of the major regional centres, particularly those markets that still offer up things like commuting opportunities back into the major working nodes. So if you think about if you're moving out of Sydney to, say, Newcastle, you don't want to be commuting every day, absolutely not. But if you had to do it 1 or 2 days a week or infrequently, it's probably doable. In addition to that, you get a lifestyle upgrade, close to the beach, you're in a much lower density environment, which is pretty appealing at the moment. You're typically paying a lot less as well. You can step out of somewhere like Parramatta, where the typical price is a bit over $1 million still for a house, and you can buy somewhere much nicer, hopefully remotely. So these are the trends that we're seeing across southeast Queensland. You can see Noosa really stands out. This is a rolling annual change, right? So it's a little bit more smoothed out, but it gives you a bit of a feel for some of the regions that we all operate in or live in or know about. So Noosa stands out with values rising a little bit more than 12% over the past 12 months. The Gold Coast is still quite strong. These are council areas, right? That's why I've split out Noosa and Sunshine Coast. Brisbane there as well as the local government area. But even though the market's now racing along, you can see that there have been periods in the past where the market's been much stronger. Look back at the early 2000s, for example. That's when, everyone knows Bernard Salt. He started talking about the sea change. I'm not sure if you coined that term or not. It's the Gold Coast and the Sunshine Coast, areas like Mandurah, south of Perth, were big parts of that story. And we did see a lot more people moving into those sea change locations, either looking for holiday homes or retirement options, or being able to commute from those areas. Back in the early 2000s, of course, technology wasn't the same as what it is now. You didn't really have an opportunity to be working remotely like what we are through COVID-19. If you overlay Sydney and Melbourne on that graph, you can start to see also how most of the other regions around the country have underperformed post-GFC. Sydney and Melbourne have been the two markets that have really stood out from every other market around the country, partly because their economies are very services-based, rather than, say, in WA or to a lesser extent here in Queensland, being more mining-based as well, or resources-based. Another reason comes back to extremely strong population growth in those markets, driven by a real surge in overseas migration, which of course is now pretty much stopped, and has stopped indefinitely. If anyone tuned into the budget on Tuesday night, hopefully everybody watched that. I did with a couple of beers, it was really good watching. I know that's not everyone's cup of tea, but the hidden deep down in the budget papers was that interstate borders probably won't be opening until the third quarter of next year, right? Hopefully it's a little bit earlier than that, but that of course does have a big disruption to housing demand, particularly rental demand. So how does Noosa sit within that whole context of the Australian housing market? I know there's a lot of fine print on here, I apologise for that. You can probably digest a bit more when you get it in your emails. But Noosa is the 66th most expensive council area around the country. So there's 65 council regions around the country that are more expensive than Noosa. So even though we probably feel like housing is quite expensive here as a local, we can see that if you're selling out of somewhere like Austin or Sydney, Hunters Hill, Waverley, around the eastern suburbs in Sydney, you can sell out of those markets and have a lot of spare change to buy lots of toys buying into Noosa. I think that's one of the main drivers that's helping people to get into this market, riding that wave of equity growth or wealth growth that's been so evident in Sydney and Melbourne over the past decade. It makes it much more achievable to buy into a coastal market or a lifestyle market like Noosa compared to a lot of other regions around the country. So we start looking at other ways to measure the marketplace. I talk a lot about median values and indices, but they only tell a very small part of the picture, particularly here on the sunny coast. When you start dissecting the marketplace down into, say, quartiles or deciles or anything like that, you can start to see the range of pricing in the market. I've just got a few examples here. This is every suburb across the Noosa Council area. The median's in the middle, but you've also got the lower quartile, which is your most affordable, 25th percentile, gives you an idea of entry point prices in the market, or your 75th percentile, which is your more premium end of the marketplace. So somewhere like Noosaville, where we are here at the moment, you can see the entry point is still around $870,000, getting close to $900,000. But of course, if you're buying into the A-grade market that Adrian is talking about, you're looking at well over $1 million to get into that sort of marketplace. If you're getting up to, say, the top 1 or 2%, Adrian, you're getting up around what, the 8-9 mil mark, I suppose, like that. Yeah. So what about the actual selling conditions? This is really interesting. When we start looking at how much supply, or what you might describe as effective supply, is in the market, by that is simply meaning how much stock is available for sale, you can start to get a feel for why this market is so strong, why it's so tight. So there's only about 600 properties that are being advertised for sale across the entire Noosa Council at the moment. That's houses and apartments together. Go back, say, 10 years, that was more like 1,600, right? So 300% more than what it is at the moment. And we're seeing the number of homes as a proportion of total dwellings is pretty much at a record low on the market now. Only about 7% of properties are currently being advertised for sale. So it gives you a feel for, well, is it a buyer's market or a seller's market? Absolutely, it's a seller's market. We're not seeing very much discounting in this market at all. Right? Discounting is simply a percentage measure of your original asking price on a property and what the contract price is. Right? So you express that as a percent. At the moment, we're seeing discounting rates across the council area of Noosa only around about 2.5%. Pretty close to being at a record low, and it's trending in the right direction if you're a seller. And homes are generally selling at about 25 to 30 days as well, which again is close to being at a record low. So that's the effect of really tight supply. And being in a marketplace where supply is tight and demand is rising, of course, that's going to be driving prices higher. So what about looking forward? And I've tried to include a few graphics in the local area because I thought this was a stunning photo from Bob Simpson, which I thought I'd include here. That kind of portrays the theme as well. You know, there are a few headwinds around and a lot of uncertainty, but also there are some opportunities and tailwinds helping the market along as well. So from a headwinds perspective, clearly we're in a stage now where fiscal stimulus is starting to wind down. Despite the fact that the federal budget announced a lot of new spending, we're going to be seeing government spending on JobKeeper winding down from about $18 billion a month to $3 billion a month. Okay, that's going to have some upwards pressure on things like labour markets or unemployment, underemployment as well. We're probably going to be seeing more small to medium enterprises having to close their doors as this stimulus runs out. So that's probably one of the biggest headwinds here is how does the market actually cope with that? What about all the distressed borrowers that are currently taking a repayment holiday at the moment? So that 9% of house loans, home loans across the country, currently the borrowers aren't paying down paying down the loans, not even paying down their interest. That's starting to change. Back in June, it was 11% of all loans, now it's 9%, but it's still significant. I think as we start to see the numbers updated for September, it starts up to August from APRA, it's going to show a much more substantial fall rate in the people who are taking a mortgage repayment holiday, simply because all the lenders have moved through their 6-month checking period. Okay, remember, mortgage repayment holidays don't expire until March next year, but banks are obviously encouraging those distressed borrowers that they can get back into a repayment cycle to do it now. But if you can't, banks are also being very frank, is my understanding, that if you aren't going to be back in a position to repay your debt, it's time to get your shopping order and look to either offload your asset at a time when selling conditions are actually pretty good and the prices haven't moved all that much. Probably good timing to be reducing your debt if you're in that sort of situation. We've also got the fact that home loan arrears are going to start to rise. The 90-day arrears rate is simply a measure that banks and APRA, the prudential regulator, look at to understand and get a feel for how many people are behind in their mortgage repayments. Generally, if you're more than 90 days in arrears on your home loan, that's when you start to go into a foreclosure process or you're getting discussions with the bank to start managing your debt in a better way. Coming into COVID, the 90-day arrears rate was only about 1%. If you take out WA, which is getting close to 2%, because the market there has been so weak since 2014, the typical home price in Perth, by the way, is still about 22% lower than what it was back in the middle of 2014. So you're buying in Perth now, you're paying prices roughly in line with 2006 prices. But if you take WA out of that, the 90-day arrears rate is generally below 1%. That's probably going to rise up to around maybe 3.5%. I've got a rule of thumb here the Reserve Bank uses for every percentage point rise in unemployment, you should expect to see about a 0.8% lift in the 90-day arrears rate. That probably won't ring true at the moment, mostly because the higher unemployment rate is mostly being driven by more casualised workers, part-timers, rather than people who own a property as more renters. Right? But absolutely, it is going to rise after March, and that will also result in some urgent distress listings coming on the marketplace in some areas. But the tailwinds, I think, are going to outweigh the headwinds. Okay, tailwinds factors that are likely to support housing demands. The number one tailwind is going to be interest rates. Interest rates are already really low. If you're paying a mortgage and it's got a 3 in front of it, generally you're paying too much, right? So you should be looking for mortgage rates around the 2s, even seeing some banks advertising fixed rates now in the high 1s, right? So definitely, if you're on a higher rate, start shopping around. Obviously, lenders are looking for high-quality borrowers, okay? You might wonder what a high-quality borrower is. It's somebody who has a job, for starters, but also who has low debt levels relative to their incomes and has a solid repayment history. That's where you're getting the best interest rates. You can see some of the standard mortgage rates off to the right there, definitely getting a better deal on fixed rates at the moment. And we're about to see interest rates come down a little bit further, is my guess. Very clear, they don't want to push the cash rate into negative territory, so it's probably going to land around 1 basis point, 0.1%, from its current level of 25 basis points, which means the cost of debt for government and banks is extremely cheap, and they'll hopefully pass most of that on to mortgage rates as well. Interest rates are going to stay low for a long time as well, which is giving a lot of buyers certainty. Why can I say that? Because the Reserve Bank, who sets interest rates, or at least the cash rate, because we're very clear that I'm going to push interest rates higher until the unemployment rate comes down to approaching what they describe as full employment. Generally, full employment would be considered to be around 4.5%, maybe a little bit higher than that now. But considering it's up around the 7% mark now, it's probably not going to peak as high as what a lot of people expected. The RBA is expecting unemployment to peak around 10%. It's already started to come down a little bit. You can see underemployment got up around 14%. It's starting to come down a little bit now as well. The other factor the Reserve Bank will be looking for is inflation. Okay, inflation is an absolute donut, if not even moving into negatives now. So it's going to be a long time before inflation, the CPI, gets back into the target range, which is 2 to 3%. Remember, our Reserve Bank is inflation mandated. They haven't had inflation back in the target range for quite a few years now. And it's going to take at least a couple of years for inflation to get back around that 2% bottom of the range. What about the budget? Well, the budget did have a lot of stimulus announcements as well, particularly for the housing market. It was around tax cuts. Obviously, if you have more money in your pocket, then you've got more money to be paying down debt, or you have more money to be buying stuff as well. And 60% of the Australian economy is consumption-based. So I think part of those tax cuts, bringing them forward, is encouraging people to spend more as well. We've got a few more announcements around things like JobMaker. If you bring on an apprentice or a new starter and the government's going to pay half their wage, that's a pretty good incentive to be bringing on more staff and help to bring the employment rate down and create more jobs. You can read through all of this there, and obviously the budget papers are all online, but also for the housing market, we're seeing a lot of stimulus for first home buyers. First home buyers are about 30% of mortgage earners at the moment, way higher than what they would normally be. Long-term average is about 24%. Finally, a lot of people are saying that the government shouldn't be taking on more debt. Fully disagree with that. If you look at our debt levels as a government, they're extremely low. Gross debt to GDP is tracking around 40, 41% across Australia. It's been more than 100% the last 20 years in the USA. Much higher in some of our more comparable markets like the UK as well, Germany. Whatever options you want to take from this graph, it's a great time for the government to be taking on more debt now because the cost of debt is extremely low. Household debt, on the other hand, is extremely high. That's probably one of the bigger risks of encouraging people to take on more debt is the household sector is looking a little bit vulnerable. And on top of all that, we're about to see credit becoming a little bit easier as well. So you might have seen another announcement from the Treasurer was winding back some of the responsible lending regulation. And it might sound like a bit of an oxymoron or a paradox after we've come out of the Royal Commission, very much focused on responsible lending. It's, if this law gets passed or the legislation rolls back, from March next year, we'll start to see it become a little bit easier to access credit. You won't have to prove up your incomes or your expenses to the same extent that you are now. And a lot of that risk will come back onto the borrower rather than the lender having to prove it up, which has really slowed down the application process. So it's going to divide a lot of people. There'll be a lot of debate about this, but from an economic perspective and a housing perspective, access to credit is extremely important. So this is certainly going to help to free things up. You can read my disclaimer if you like. And I'll look forward to questions when we have the time. So I'll pass it over to Anthony Gomez.
Probably one of the best economists in the country, hasn't it? They figures out great projectors of the future of the economy using great stats and great information. You go a long way to find a better predictor than Tim Wallis. Unbelievable. Like I said, every single time I hear you speak, man, it's most enlightening part of the whole lot. Welcome back to the rest of the guys that are watching us on Zoom. Ladies and gentlemen, my name's Anthony Bellin. What an interesting time to be speaking in the economy it is right now. To those who are trying to predict the future and test themselves against benchmarks that are shifting around on a daily basis. This is probably one of the most interesting times. Well, who would have thought that we'd actually be sitting here with considerable consumer confidence and a position that is looking forward with faith and also to optimism into the future when we went into the lockdowns that started around the 26th of March. Some 6 months ago, with no idea. Who would have thought that we'd actually be sitting here now trying to work out what money looks like, what wealth and safety looks like. Ladies and gentlemen, what a great time. I'll put a show together to take us through really easily on the global industry and you on the set. Okay, everyone got that. But before we get into it, The biggest event that's coming up for us right now, and the most interesting event, the thing I find interesting every morning when I go out and get the world news, is what's happening in America, the US election. Two of the most, or one of the most entertaining politicians in the history of like him, hate him, love him, despise him. The Donald is one of the great influences in our consumer confidence of all time. Has anyone got a figure? I was going to say, who, if they could vote in the US election, would vote for Donald Trump? Who would show up hands here, guys? Nice and high. Thank you, guys. Who would vote for Joe Biden if they could? I just want to check too. Is there anyone in the room that, regardless of any question I ask, I won't put their hand up and know what? So let's have a look at it and see what's actually happening. Yeah, the bottom line is we are in a recession, but nobody actually feels it. We should have been the biggest news in history that we went into the first recession in 30 years about 3 weeks ago, and it almost passed us by as though what recession, what time, what changed. You know, we're in the middle of job, people are still working, our property market in the local area was still thriving. And I'll get into the reasons why the psychology of the new property market, the one that we all live in and invested in, is actually thriving and should thrive in the future. But if I start with this, I'll start on a global basis, and the bottom line is the economy is, it must have a knock-on effect, okay? International trade, manufacture, GDP on a global status will have a massive effect somewhere around the world, but will it affect us in Noosa? But I'm saying on a global basis, will it affect the world? The answer is yes, it will, okay? There will be industry slowdown, there will be economy. US unemployment rates, guys, are at sort of 17 to 18% right now, okay? But one of the things that is in every economy, in every shift that happens like this, is there are winners and there are losers. And the truth be known is, if you're an American or a European that's tied down in economic disaster, and we're affiliated with a French company for one of my largest clients, and things are really tough over there economically. Most of the Euros, Americans are actually looking at the Australian market going, I want to live there. An unbelievable economy. Our COVID numbers, for starters, is one of the biggest attractors here in Australia against the rest of the world. If you are England or America, there are numbers that really threaten the family and social safety of the population. Our numbers, and like I said, even without what happened in Melbourne, which is sad and unfortunate, we were running around 104 people before the second wave. Now, so around the world, that is the greatest advertising link for people who will want to come to Australia. Immigration will start to become the hot list in Australia, and to pick up on some of the points that Tim made, demand will constantly lift our market, okay, by an integrated market. Now, government will be open to allowing people to actually move into our borders and actually partake in driving our property market up. Staying on the global scene, there's a couple of other parts. The US election is on global confidence. This is quite interesting. If I go to the Australian market, in the middle of COVID, when we had that big fall, we lost 37% off our market in a period of about 11 days. 37% came off the ASX. It's top 200, that's right down to the smaller caps that are on there. The US, in terms of confidence, only lost about 5. It is back to the point where it's only 5% behind. Now, we've rallied back from 37% loss on our total ASX market to only 15% down from where we actually got there. Now, there were people out there who didn't know where the markets were going. The larger whales, the high net worth individuals, say the Alpha Max Forward, were confident they'd been here this radio before. They were buying BHP when you could buy BHP stock as low as $25. Now they're working around $37. BHP is on one of Australia's safest companies with forward contracts over the next 16 years. Some people have actually made 50% return on investment in 3 months. That's an unbelievable return. And this is where we're showing in the whole world that confidence is probably one of the biggest drivers to actually coming through this pandemic. I'll talk briefly about what some of the scientific and economic data says about the vaccine and what that really means. And there is a lot, even in our government's budget, which Tim handled quite well and mentioned it, and thrown gold bars into the Australian economy. One of the biggest parts that actually took place in that one was the ability to draw down money at the most ridiculously low lending stuff. So we heard a lot of debate about the budget that popped down during the week. The truth is there's never been a better time for Australia to actually pull money down, draw it down, and inject it into the Australian economy. I actually noticed, I don't know if you guys picked up the picture that Tim put up of Josh Frydenberg, the treasurer. That must be his Tinder thing, mate, because that's 25 years old, that picture. Unbelievable treasurer and an unbelievable prime minister we have right now. They are treasury and economic people, and they've done a fantastic job. We are sitting in a lot of a strong position here because of the strong decisions that were made by our governing seniors in the federal government. Yeah, it's a little bit rich. I'm tipping there'll be some sort of constitutional crisis somewhere in Australia the next year, because it did not seem strange to everyone when the Prime Minister says, I want borders open, and the Treasurer, a Premier, going to the Queensland can say, no. That seemed odd to me. You know, again, I should have studied political science a little bit more closely at school rather than economics, but it was a really, really odd thing for the most senior politician in Australia to be able to come out and say, I want borders open, and a state premier to say, I don't care what you want, we're not doing it. Really, really odd. And that will probably be played out a little bit more into the future to work out, well, how does that work? The Prime Minister can be Queenslanders or Victorians to war, but he can't actually get a border open as government if he wants to pass between both. So it's going to be a really, really interesting part leading on. So I picked up before on the Trump set. Interestingly enough, if you watch the Dow Jones, which is obviously the premier reporter of US stocks and capital markets and equity, as I said, it's only 5% down from the worst part of the COVID before. So stocks in America are high. The US capitalists actually are intending and believing that the US is actually strong. It is actually getting that strength and confidence from the hour of power that Trump puts out there every day, whether he's right, wrong, or indifferent. The confidence that he and his administration bring is what's holding up the economy. Now, when the opinion polls come out, it's really interesting. If you watch the opinion polls moving around on who's going to win, if it's going to be Trump or Biden, whoever it's going to be, if you watch the opinion polls, capital markets, when it comes out that Biden's actually making ground and could possibly be the next US president, watch what happens to capital markets in America. They drop off. The whales start selling down equities because they actually do believe in the Trump administration being good for capital markets. If we're interested in knocking on effects that come all the way down to our places in do so, our economy, then we're interested in the US remaining strong. We're interested in the US believing that they're the biggest and most powerful nation in the whole world. And that actually is going to be a part that feeds onto confidence, and it will follow itself all the way down to the micro economies. So what's going to happen in China? Big question. And I still think that part is an unanswered question in the future of the world. Some of you might have recalled that the Privy Council in England talked about the possible liability that China has to the world on coronavirus. It came out around sort of late May, early June, and comments were made that if China, for argument's sake, had failed its World Health Organization requirements and not reported that they had a duty of care, and that somehow all the world economies are linked to having some sort of liability against China, that was actually pushed by the Brits. We would have seen Trump's actually mentioned it a couple of times. This is going to be an interesting part. And if we look at how China responds to that, have a look. Every single time someone says that China did something wrong in coronavirus, have you noticed how aggressive their administration is? They don't want to talk about it. They don't want to negotiate around it. They just come back buildings. And actually, sort of a couple of ministers in Australia have actually mentioned, the problems with China and how that's affected Australia. And then actually, the Chinese government has actually lifted tariffs on things like barley, imports down there, sort of another. But the one thing that will hold us straight and secure is they need our iron ore. So the one thing going for China is they haven't got anything under the ground. So they actually need what we've got under the ground here. So Australia and China are linked as trading partners. And the truth is that's good for Australians into the future. Okay, our GDP relates high and heavy to the ability of our largest companies to continue supplying into China into the future. So we actually have a strong and stable economy. So if we're pushing down, I'll say this blanket statement, if we go back to GFC, most people were around for that in business, in economics, in investment. That was, like I said, in 2007 going into 2008. What an interesting time that was. So when it finally popped out about March 2008 at the full low time. And the banks were the parts that the world governments were bailing out. They were in trouble. They started off with obviously the American getting sort of larger corporate markets, the mortgage markets that were lending up 120% over the valuation of properties. And that actually was a big economical punishment to starting in America and finding its way all to Australia. I can remember sort of around that time, half of Palm Beach was on the market within 2 weeks. Palm Beach is in the northern suburbs of Sydney. It was like a playground of the rich and famous, usually secondary properties. It hit the market. People who bought for $7 million in 2006 and 2007 were selling their properties for $3.5 million just to get out of the market. The banks were lending in on equity, and they were making things really, really difficult. Remember, interest rates around those times were sort of still up around 6 or 7%, so it was actually a lot higher than it was now. And this is probably, when I get into the reasons why I think we're going to be okay here, and it's to borrow back on the same points that Tim made, our interest rate depth is, or low standing, is the greatest saviour of where the Australian market will be in the future. Last time we had a recession, those words, the recession we had to have, were made by our Labor Prime Minister Paul Keating in 1992, coming off the back of the 1987 world stock market crash, the recession that we had to have. The big difference was in that time, interest rates were at 18% in those 90s. So it was impossible for business, personnel, anyone to actually get ahead with those sorts of sets. Now we're back in recession and interest rates, as Chris rightly said, you can borrow in Australia with something with a 1 in front of it. It's almost to the point where it's actually not costing you anything to have a mortgage, and the cost of interest at 1.6% was the lowest I've seen so far. Have you seen anything lower than 1.6, mate? Yeah, I saw 1.6 being given out on fixed rates, 5-year fixed rates in a week. Wow. And it wasn't that long ago that interest rates were sort of running around 4.5 and 5. So we are in such a good position when compared to the rest of the world to actually see this part of it out. But I did mention that before because banks were the problematic people who needed bailing out. The new people who are going to need bailouts are airlines because they're not doing anything. They're the most severely affected, and the government's going to have to come into it. We've seen what's happening with Qantas. Qantas was one of the strongest balance sheet companies in Australia if you went to February 2020. 50,000 staff, incredible amount of assets, and now Qantas is actually at risk. Their planes aren't flying. Just as a side note too, I started survey. Don't be the first person to go on an A380 trip. Those things are meant to be flying all the time, not sitting going into the deserts, sort of waiting it going. Just saying. But the highest risk, sort of that will be there is the maintenance of these aircrafts. As I said, the modern day aircrafts are made to be flying, not to be actually sitting on tarmacs. And that is going to be a risk to the airline industry. Qantas's unbelievable record will actually come into play because literally other airlines, when they do start going again, they're actually got to deal with the fact that their planes have not been flying for a long period of time. Pilots, for argument's sake, haven't been getting their hours up, which they need to get up and orbit because the planes can't actually get up and down. So the airlines are actually going to be a really interesting part all around the world, not just in Australia. But Qantas obviously making some really hard decisions. They backed off their sponsorship of Wallabies. That wasn't going to be the thing that was going to lose all their money, but so the investment in the Wallabies is probably like a great one right now. Interest rates will be our world saver. I've already sort of mentioned that point because they're so low. We are almost to the point that Japan's been at years ago. We're almost at negative interest rates. I agree entirely with Tim's point that we are going to get another cut, but they won't go to zero because we're sort of running out of places to go. But the one thing that I am comfortable with is it's going to be 4 or 5 years before there's an interest rate rise. And that interest rate rise is not going to see things fly back up to 4 or 5%. It will only be a gradual set. So the investor that's shrewd right now can actually find the opportunities going to sort of where other parts of the crisis. Number 6, this vaccine thing. Our budget actually has come out intending, I don't know if you saw the Prime Minister on interviews in the morning after the budget, he was very strong. It relies on a vaccine actually being injected into the Australian economy and possibly being mixed around the world. This is going to have a really interesting demographic and set on it because the question is will all Australians accept and have a vaccine? The anti-vaxxers are going to be around. The question is going on, I'm trying to think about myself, don't get it because you're going to be penalised for not getting it. You won't be able to fly internationally. So the government will do everything it can to actually tell people to get it, but I'd like a few of my friends to get it before I do. Now, I'm happy to wait for few international travel just to see if after you get the vaccine, your friends grow a second head or something like that coming out of the side of it because of the speed that they're getting. But the issue will be is that this vaccine is actually, we are hanging on this new budget and all the money that's going down to the fact that the vaccine actually will be happening in 2021, getting distributed around. And so it's going to be a really interesting part is, will we as Australians say, just get the vaccine, line up, have it, don't be penalised. And the general consensus is about 70 to 75% of Australians will go for it straight away, and then the question mark will be those who don't. The way the government's going to actually try and, force their hand, is that there will be massive penalties for those who decide not to have the vaccine. And I've got to say, from an economy and a business return point of view, you can see why the Prime Minister and everyone's hanging so much on the vaccine actually being created, it being effective, and actually leading us back to relatively strong engagement in GDP over the next 4 or 5 years. More production demand, is the biggest issue. So as soon as we're firing again, things will change. But right now, there's going to be massive pressure on that. If you go to car market, for argument's sake, car markets around Australia, even luxury vehicles, are surprising everyone. They are turning over. The psychology that takes place around, there's people going, I'm restrained, I can't live the way I used to, there's no holidays for me and the family. And the other part of the interesting psychology, I saw it in a great, it wasn't Bernard Salter, but it was another demographic came out the other day, is a lot of people are having midlife crises at 35 years old. They're going, you know what, if life's going to be like this, I'm going to spend it. I'm going to enjoy it. I mean, if I go to another lockdown, I will almost retail therapy myself out, and I'll buy a beautiful home and I'll get out. And that is actually, I'll get on to the reasons why psychologically Noosa is an awesome place for those people who have actually gone through a hammering down in Melbourne. I think in our record, we've been on the fastest sales 3 hours. We've got 911, sight unseen on the internet, which is the Melbourne Wire. Now, try and think these 4 guys have been in quarantine and locked down, and it was almost like a panel beating storm, a hailstorm for panel beaters, and just saying, I just need to get out. We painted the property on there within minutes down there, so we were inundated with people just trying to offer to sell on that property because psychologically, if you were down in cold, in the middle of winter in Melbourne, it's hard enough, do you know what I mean? And to be actually locked down, kids, and the options to actually go to a paradise, to a resort type centre, where COVID, for starters, is very, very low. I don't think there's been a case in Noosa. There was a bit of an outbreak of sales. I'm not sure if that was just the common flu, but it actually lasted and went through the economy for a little bit. But effectively, these areas, Byron Bay, Queenstown in New Zealand, are some of the most highly sought after because they are resort style living. People are getting used to the fact that if it's going to be like this for a while, I'm going to live well, I'm going to have a pool for the kids, or just a great place to live. The other invention that we weren't ready for this in global financial crisis, but the mobile workforce and working on Zoom has actually proven to actually be a point where most company CEOs, business leaders, and even small medium people have found out they can actually operate their business very effectively from their home. So then you go, if I can run my business from Sydney or Melbourne, why wouldn't I live in Noosa? Tim made a very good point too. Average sale price or affluence areas, and you're selling at 10, 11, $12 million, that same square meterage, the same block of land that you're selling out of in sort of some of those larger Melbourne or Sydney property markets, buys a lot up here. And then retirement spending becomes a really important issue because if they're dropping a place for 10, you're getting almost 5 bedrooms, sort of 3-car garage, almost everything happening up here. And some would argue a better market to live in. Transport is generally good out of COVID. There's 6 to 8 planes to Sydney per day each way and coming back up here, which means it's almost like shuttle tripping. Most parties, the Zoom has been proven to be an operator, are going, I will live in that paradise market. But probably 15 or 20 years ago, people said, I'm going to get to Noosa, but I'll get there when I'm 65 or 70 years old. And we'll have dinner then going into it at 4 o'clock in the afternoon. But what's happening now? Younger people are located here and they're having families here. They're bringing kids here. The infrastructure here is unbelievable. And that's another reason why the Noosa market is so highly sought after. And also, too, most people are smart in Noosa, highly educated and understand the property market. So it's so closely held right now. There's hardly any properties given the amount of demand that's in the Noosa market. They're reaching out exactly as Chris said. We are close to 1/3 of properties on market in Noosa because no one wants to sell in an upwardly moving market. Our grandfather sold us out when we were 6 years old. We sell at the height of the market and then buy and buy and buy. And so that's again another psychological reason for I'm used to seeing so well. So let's talk about Australia for a bit. And I said I think I've went through quite a few of these points and I'm conscious of your time on a Thursday night. But our market is still strong because it's a sparse market. It's a very affordable market compared to the rest of the world. Our market has got incredible dexterity. A Bondi apartment that's a 3-bedroom, 240 square metre apartment in Bondi is selling right now for about $25,000 a square metre. If you buy the same apartment on Central Park, New York, same size, same shape, it's going to cost you close to 3.5 to 4 times as much. But the problem is in New York right now, it's still not a great place to live. New York is still problematic all through it. They're going back into their winter now, which is going to be a problem for COVID. They've sort of come out into the we're going to summer, they're going back into the toughest places going into this virus that causes sort of major problems is in cold climates. Melbourne, for argument's sake, into a cold climate. Every doctor's talking about Northern Territory, no cases. Queensland, very few cases. This virus tends to actually expedite itself in very cold climates. America's going back into that. They haven't really got a massive COVID plan. So who would want to live in America in an apartment that's costing you something like $125,000 per square metre US, when you can actually live on the beaches of Bondi by getting $25,000 a square metre? That's a major reason why our property market is so incredibly undervalued. Pushing on that, we also should be taking into account our stocks, our market, what's happening out there. Now, the issue that's going on is that most investors cannot take term deposit safety anymore. As we mentioned, if you're lending at 1.2%, 1.6%, up to 2%, that means our term deposit rate is actually now sub-1s. It's horrible. So if you're a self-funded retiree, you're forced to go into the Australian stock market where you can find returns of 6.5%, 7% ex-dividend, and you're forced out of term deposit because term deposit rates are so poor, they're actually meaning that people in the self-funding retirees are digging into capital, which is a no-no domain for the support of superannuation to back the country. Our markets have winners and losers, but the banks are solid again. Okay, there's been great. CBA, Westpac, the majors, ANZ and NAB are solid stocks into the future. The ability for people like us to actually now not be told by the banks that responsible lending will stop you from being entrepreneurial and actually put the onus back sort of on the borrowers, which is us, is an amazing sort of part for the banks. When that announcement came out, that APRA was actually releasing and going to let banks lend more money, you will see all banks went up by about 5 to 8% a day. Okay, an amazing set. So I like banks into the future. I think they're strong. They're going to keep lending money, and there's going to be Australians after this new budget that are going to hold their jobs. They will hold their jobs. So our unemployment rate will still stay sub 10%. Now we've got a little bit of a trigger there because some people are only partially employed. So the truth being is, if you really add it up, we are probably somewhere more around 10 to 11% of total unemployment, because a lot of people off JobKeeper are actually just sitting on couches at home. They're on it. The pubs aren't working, the restaurants aren't going in Melbourne, but they're still getting paid, even though it is down to the amount. We're going up from $1,500 a fortnight to $1,200 a fortnight from the 1st of October going onwards. But those people are still considered gainfully employed. So it's sort of artificially keeping our job rate looking a lot respectful. But the government likes that. It looks nice. It looks good. When people read our unemployment figures around the world, but also to in Australia, it will hold. They threw gold bars at this budget. I mean, sort of was unbelievable. I reckon it was one of the best budgets that's ever been written. But remember, our Prime Minister, well before he was actually Prime Minister, was a Treasury guy. He's written budgets, he gets numbers, he gets consumer confidence, and he gets it. He has to keep the country going. And it was also pointed out quite rightly by Tim, there's been no better time to draw down debt. And a couple of naysayers came out and said, oh, our kids are going to inherit the debt. How's this? I don't care that my kids are going to inherit debt. They've got a great life. Okay? They've got a fantastic future and opportunity. The debt that's sitting on the national balance sheet, I would rather them have gainful employment when they're 18 or 19 years old when they come out. So we shouldn't be worried about our country taking on all this debt and saying, oh my God, we're going to go $1 trillion in debt. So what? It's not our debt. What we want to do is have our property values hold, the job market remain calm, optimism and confidence in the economy. And if that took a massive injection of capital into the market to actually keep jobs and keep confidence going, it was money incredibly well spent. Compared to the rest of the world, it's no time for us. And lending it, don't forget too, the government is lending it at sub 1%. So it's almost free money. So we haven't got to worry about massive debt and interest rates going through and then the country going back on GDP, because the money cost is almost absolutely nothing to what we're still producing. So banks will continue to lend, they're going to continue to be strong. We actually can function pretty well here in Australia without a national activity file. So even if it doesn't light back up and planes aren't flying in with Americans in, and I know I've got a great mate watching this who's boss of a major hotel group, sort of troubled by this, but even if we don't get international tourism coming back for possibly a year, year and a half, where you don't have to go to quarantine, we can actually trade our way through this. So many people are actually travelling to places in Australia because they can't go overseas, that they have what we've got. And I'll tell you what that does, that makes jobs. That activity is good. And so even areas like Noosa, when finally the good Premier opens up the borders, I used to quarantine for 14 days, so I've got a little bit of a problem with that to get back into here. But when the good Premier does open up the borders, all of the most beautiful resort type suburbs, you know what I mean, sort of an opportunity for people to come and taste the Queensland are going to be there. And again, that will make jobs, which means that there'll be taxes paid, they'll be earning those people with jobs will actually go and spend, go to the pub, they'll go and spend, go on sports here, on whatever, and that will keep our economy sort of turning over. So we're actually not in bad nick to actually do quite well, even without international tourism. But the people you've got to feel most sorry for is, of course, tourism operators and hotels. That's tough for them. All right, number 5, cash savings. Where do we go right now? Stock market. Okay, all of the money coming from our wealth creation fund, about $4.5 billion, is all flowing straight back on the stock market. Why? Because self-funded retirees and people need return on investment. They cannot put their money in a term deposit because it's almost like burying your money in the sand or putting it under the bed. So it has to find its way back into safe stocks. As I said, the bank's popular. AAA stocks will still continue to go well. Our mining and resource stocks, with a caveat on just watching out for relationships with China. And so any embargoes or risks or issues that come up with that, at the end of the day, China does need what's under the ground in Australia. It needs to get its infrastructure going. It needs to continue to actually buy what's under our ground, so it can import it into its own economy as well. Number 6, will there be a market correction? I think so. So don't freak out if it does happen sometime over the next 9 months. We're just coming off JobKeeper, okay, and then after that, a lot of people's mortgages are actually just coming back on. So it's like a bit of a double hit going for those people in there. But the market correction, I'm not expecting it to be massive. So there won't be a Black Thursday or a Black Monday that's sort of horrid sort of drop off, but there will be some sort of shake. I'm tipping that market correction is probably going to be Q3 2021, so somewhere around March, where people start to work out, okay, it is a little bit harder out there. Business to business transactions come off, business to consumer transactions come off. Don't get freaked out if we hit at Christmas at retail, it's not completely unbelievable. As I said, the government did a really good job to actually make it a good Christmas. It was like the Santa Claus budget because spending will be encouraged to keep going around the economy. But there will be some sort of part there in the next, I said we'll probably get past Christmas and people will start to go, okay, cool, this is what COVID is actually doing, and there'll be just a leakage and the correction won't be major, but it will take place. 7, what this week's budget will achieve? I've gone through that already, guys. And I just want to talk about, the new part, coming down to the individuals in the room to just close out here before we go to some questions. Use of property is doing so well because everything is good about it. Crime rate is low, return on investment is fantastic. In terms of resort style living, I've said this from I'm a homeowner in Noosa. What was that time you flogged me that expensive property up here, mate?
Yeah, you've only made about $5 or $6 million.
27 months. The fortune papers are brave, thank you, mate. But that is the case. Noosa, like I said, everything about it is perfect. I've been saying for 3 or 4 years, Noosa is like the Monaco going into Australia. Everything is going for it. Services are great. The weather is fantastic. The infrastructure is best. My kids are in school in the local Noosa market, and I'm shocked they come from private schools in Sydney and they're doing better than what they were in the private schools in Sydney. When we talk about the resources and the to get there, it offers a small town city. So why would everyone in Australia, especially now with Zoom capability and easy access back when they open up the borders, want to live in a place like this? Byron Bay is getting the same money. You cannot find property in Byron Bay right now. Who ever thought the hippies would actually be making so much money from smoking ganja on the side of the wall? So it's an amazing sort of setting. Everyone from Byron's watching, I look up the face as well. But who ever thought that Byron would actually have that run? As I said, Queenstown and New Zealand have been amazing as well because people want a safe place to live, a sparse area, and an enjoyable lifestyle.
to partake in. At the lending changes, start sort of coming next year, that's going to make property even better. People are going to have access to money that people will get loans that didn't used to get loans. They'll back themselves and they'll be, for once, not told by the bank you can't afford it under responsible lending. They're saying, well, if you're an entrepreneur or you want to borrow and get this house, you've got enough equity in it, your income might be close to our barriers, but you know what, it's on you. And Australians will rally at that opportunity, particularly the low interest rates that we've been talking about before. It won't cost as much to loan. We're in a seller's market, and I think it's going to hold. I think this will stay a seller's market right here for some time yet. When will it become a buyer's market? If there's a flood of people saying, I think we've hit the pinnacle, I think we've hit our top point, and then more property comes onto the market, significant to equal the same part of consumer demand to get in there. And that might mean the opportunity and choice down the sort of does actually segment off, but it won't fall. It will not fall down the sort of for all the reasons that we discussed earlier on today. Interstate recovery is a must for recovery, so we've got to be really cool on that one. Right? Yeah, I don't know, like I said, how everyone feels about Queenslanders, sort of not allowing anybody else into the borders. But the truth be known, for the national economy to thrive, and Melbourne is a part of this as well, we actually need to get to the point where we're travelling back and forth. We should have an attitude that this COVID thing, I mean, will take a fair while to go away. There will be small outbreaks. There will be. We don't have to panic every single time. We don't have to go, okay, cool, we're well equipped. The ICUs in every major hospital hardly had any. People get to the point where they're at sort of outside of obviously aged care factors and some of the other issues. ICUs around the country. I remember I had a COVID test in St Vincent's Hospital. They said they had 160 rooms there. This was in July this year. I just went in there because I had a sore throat and then they gave me a COVID test. So I asked a few questions around it. They had 160 rooms and the highest amount of occupancy that they had in those 160 rooms they put down there was 17. So we're well equipped to handle it. So we don't have to freak out every time. And again, my good friend, the Premier, she's put New South Wales back now as a result of this. I think 3 live tests yesterday came back. So we start the 28-day period again. So what was going to be 1st of November to allow people to come into Queensland is now actually going to be put back by 7 days, so it'll be like 6 or 7. So hopefully, like I said, but the truth be known is three live cases is not a major problem. Donald Trump proved that the other day by having COVID and coming out 4 days later to say I'd be cured. So you reckon that wasn't a setup? Telling you the highest possible setup, the greatest things. These are some stats that sort of following with 5.3 level borrowing, so it means that people are lending money and they are getting approved and they are taking their money in property, which sort of backs up again to what Tim was saying before. Predicted increase in listings and will come, and also to an option for volumes. As people start to see we're getting to the top of the market, they'll hold, and then they'll go, it's time to actually sell now, and then move on to another property. With things racing and going crazy, I mentioned that before, Palm Beach in Sydney had 50% in 2007, 2008 drops. People buying for 3.5. If you go to the auction at Cleveland Track last week, there was a major problem going on there because agents are appraising the lounge rooms at $1.82 million for places in Barrenjoey, and 40 people are turning up with contracts at auctions, and you're getting results of where everyone's expecting to go from 1.8 to $2 million, they're going to 2.9, 3.1. Now, there's some OFT issues there because there's a good real estate agents in Sydney not meant to quote about 10% of the market. I feel sorry for the agents because it's just so hard to pick because it's unprecedented. People turn up and no one can work out why with 40 bidders at auctions and it goes figures. So on that sector, I mean, that will start to increase as people start to seek out with a higher and higher. But then actually people who are thinking of selling will hold off to wait until the market's going to, they think it's going to improve in Q2 or Q3 next year. They're going to go, well, let's wait till then so we cash in our chips and sell for a little bit more. I'm just going to close on this. Just keep an eye on your own personal wealth. Really important part right now because while sort of the economy is at high concern, some people have had an attitude sort of just contained. There are so many opportunities in the Australian market that they may not be able to be shown to you ever again. So most people in the room that sort of away from the property and on top of after sort of work down the mortgage on their property, remember, even to the point where if you're lending at 2%, call it as a number, and the market's returning 7 or 8%, don't miss those opportunities for the arbitrage and making 5% by drawing it down off your mortgage and investing in sort of other parts that are going to create wealth for you rather than simply just paying off the mortgage on your property, which we've been taught to do for the last 20 or 30 years. So remember that there's got to be a sign your property value is going well, but the second stream of income is actually to use that equity to continue to invest at arbitrage amounts because the cost of money is so bloody cheap right now. All right, guys, I'm tongue tied. I'll flog that one out. I mean, but thank you guys very much for the ability to come and speak to you tonight. I think we're going to do a bit of question time here. I'll pass over to Adrian, guys. But thank you guys very much for this.
Excellent. Thank you very much for that. I've got a couple of things out of that. I just want to kind of cap off a little bit, but I think that Tim really nailed the tailwinds outweigh the headwinds, and that for me is exactly what we're seeing here. Economic clouds, nowhere to be seen in Noosa, and I think that that's, as Anthony quite rightly pointed out, will probably not sort of turn up on our radar for some time. I think it's a very desirable place to live, and the things that have changed in the marketplace will continue to drive that. Really big difference is the low interest rates. There's no question that's the game changer for the market. It will underwrite our marketplace, and we're seeing that. And I think the freeing up of some of the APRA requirements will absolutely have a positive impact. Mobile workforce, that's incredible. There's conversations that we're having now about people just extracting their entire business out of Melbourne and relocating it to Queensland. I think that would never have been even considered in the past. And I also think that, in the past, the people that have made those really bold decisions were the mavericks of the market. They were confident. They moved their head and said, you know what, I'm going to live out my retirement whilst I'm working. There were very few and far between, and you had to be a pretty brave soldier when you're doing that. That's now becoming commonplace. We're seeing people that are questioning where they live, with the freedom of where they can work, and they're making huge life changes. And that's a consumer shift that you can't put the toothpaste back in the tube or the genie back in the bottle. That's happened now. We have to deal with that, and I think that bodes really well for the Noosa marketplace. And we're quite rightly, sitting on record level low inventory, and that sort of supports, I guess, our strong demand in the marketplace, low inventory, and I'll continue to sort of underwrite our market. And I think that's what I got out of there, some of the key points from the guys here, and I thank you both for your contribution tonight. Well, why don't we get with a couple of questions? Anyone from the floor, for either Anthony or Tim, just fire away with anything you've got.
Don't rush us at once, guys.
Yeah. There's a prize for whoever goes first. I've got one. I'll kick off with one. I was interested in Tim probably to kind of weigh in on this, but we've obviously seen no inbound immigration, and sometimes I think there's been a link between immigration and the building industry, and then therefore kind of demand in our property market. No immigration, what happens?
Yeah, there is a massive link between population growth and demand for housing. It's obvious. There's more people, you need more shelter. But the important thing to understand, though, is when you look at Australia's population growth, you can divide it into two baskets. You've got about 60% of population growth comes from overseas and about 40% from the natural increase. Of that 60% coming from overseas, about 70% of them are on short-term visas, generally students. So the vast majority of migration coming to Australia is students and visitors, long-term travellers, that type of thing. The small proportion is people who really need to buy housing. So you'll find of that population growth, most of it's going into rental demands. And most of that rental demand, about 85% of it, flows into Sydney and Melbourne. That's why we're seeing Melbourne apartment rents are falling at about 5-6% per quarter at the moment. They're absolutely getting decimated. That's in the high-rise inner city precincts, investment-grade apartments. What's becoming more important now, population growth, is the interstate migration flow, which is why we need the borders opened. That's true demand for housing. So what happens, back to your question, what happens when population growth stalls or migration stalls? There's less demand for investment-grade styles of development. Inner city apartments, medium to high density. What we're seeing now, though, is while there's less apartment development being approved, detached housing approvals are starting to rise. They're well above average, above the 10-year average. That's a real sign of the home builders grant. It's a $25,000 payment if you build or substantially renovate. We've already seen in the last 2 months the number of land sales, the number of new land, house and land packages is absolutely skyrocketing as people take advantage of that grant.
Anyone else? was keen to get home and doing it.
Excellent. Well, I'll wrap it up, mate.
Expectations of business consultancies and where you think that's going to go.
Probably was you.
Yeah, it'll be, I think this market is a great question. This market is probably, if you're an advisor or a consultant in business and you're good at your job, it's probably created a demand because of people's nerves and what the future does look like. Do they have enough staff? Do they have enough input? Is profit improvement or profit goaling is important? So my view is that they're very good consultants. The guys who are fantastic advisors have got basically out the sick and the old in that sort of innovation style, and it's a very good time for that. So it's a, we, if you look at the consulting section of our firms, so we're in Sydney, Melbourne, Brisbane, is our main bases. In terms of our heart of what has been most in demand in the last 6 months, it's all been corporate advisory and consulting. People don't care so much about their tax returns being modest on time, and they don't care so much sort of about giving their passives to sort of the balance or that, or they have been interested in investing clothing and planning for the future. So I think we're something, every single service that we have in our business advisory and consulting is constantly through the roof.
And you see unemployment having a negative effect rather than
This budget has actually been done so well because without this budget, there was going to be a massive negative effect on JobKeeper coming off, and sort of we've got about 20% of people who had JobKeeper for the first 6 months will get it for the ensuing period. That combined with mortgages that have been frozen and deferred coming back on was actually going to cause people slashing jobs to actually make sure they got their profit lines. Those slashes that are predicted for October, because of this budget, probably won't happen. Although, like I said, it'll be industry for industry. We saw Qantas companies continue to slash jobs. They put 6,000 people off exactly 5.5 weeks ago. You'll remember the scary part was Joyce, the CEO, said, we'll put in the shop right because they're never coming back. No matter what, even Qantas strikes, these are done jobs that will never come back. That tells you that corporate Australia has shifted very spending money on more technology and abilities for less people to be used on their balance sheet and more tech costs in that sense. So we have to watch into the industry on that.
Well, thanks everyone for taking the time out of your night tonight. We really appreciate you participating, and if you've got any questions, feel free to grab us online. Right, excellent. Cheers.
So,